So let's summarize where we are today and what we're going to be doing today. And next week will be your exam, so we'll spend a few minutes on that towards the end in case kids coming in late. So let's just talk about some of the material, and needless to say, if you have any questions along the way, let me know. So chapter 1, we deal with issues pertaining to some historical aspects of code, sources of authority, particularly with the sources of authority. All that should be a lot easier now in the rearview mirror several weeks, 6 weeks later. We've got a good taste of legislative authority, administrative authority, judicial authority, how they operate. Just you may find this interesting, I did, is that I've been doing some research about the origin of the Section 1014, basis equal to fair market value rule. And originally in the 1913 code, there was no code section or equivalent to Section 1014. And it was actually the Treasury Department that on its own initiative wrote a regulation to say that basis will be equal to fair market value, which was kind of strange giveaway to taxpayers. This regulation was promulgated, I believe the year was 1918. So there were several years there was no law on that issue. The Treasury Department issues this regulation, and you might say, why did the Treasury Department issue that regulation? Because keep in mind, our income tax system, guys, did not come in a vacuum. In other words, we were not the first kids in the block to ever have an income tax system. The United Kingdom had an income tax system for what it's worth. It was not until the 1960s that the United Kingdom taxed capital gains. And since our income tax was largely, or a good portion was borrowed from the United Kingdom, because it did not tax capital gains, it's fairly likely, for whatever reason, the Treasury Department chose not to, on debt, tax capital gains. So in 1921, what happened is Congress, picking up on what Treasury Department had done in 1921, Congress enacts the equivalent of Code Section 1014. So a little history there. All right. Moving on, we have Chapter 2 dealing with constituted income, Code Section 61. We get our first glimpse of what's excluded. Imputed income, for example, is not taxable. We look at Chapter 3 and 4, dealing with exclusions from income. Exclusions from income. And we saw Code Section 102. We saw Code Section 132. We saw Code Section 119, 119, with dealing convenience of employer, the convenience of the employer, meals and lodging, right? Section 119. We then skip Chapter 5. We all know awards are taxable. No shocker there, right? That you win an award. There's very, very small de minimis exceptions, but generally any receipt of it. You win in the lottery, you're supposed to, even if it's for $2, you're supposed to report those lottery winnings. We moved on to Chapter 6. We dealt with, in Chapter 6, Code Section 1001. Okay. Code Section 1001. And if you recall the first part of the chapter, we looked at what our basis is. We saw a basis could be cost basis, Code Section 1012. And adjusted basis needs to be Code Section 1016. So we had adjusted basis, Code Section 1011. We had basis determined under Code Sections 1014, 1015, 1016, 1019, a whole bunch of different code sections. Should know, always know, close to my heart, what is tax basis, right? What is your tax basis in the asset? And then we looked at what is an amount realized. What is an amount realized? And we made sure that we all knew what is your amount realized. And we know, right, that realized is always augmented by what? Say again? Can you think about amount realized? Is it just the cash you received?
No.
It includes, Anna's screaming.
Oh.
Or even any indebtedness, right? And the authority for that? This weekend you probably spoke about it. Crane and Tuck, right? Supreme Court cases which have now been supplemented by the Treasury regulations, right? So we have those, and you guys can all compute numerically the amount of gain and loss, right? Then we turn our attention to chapter 21, and we looked at what is capital gain, capital loss. We saw that there's a rate preference, right, under code section 1H for capital gains. We saw that in lieu of being taxed at possibly as high as 39.6%, that the highest marginal tax rate for capital gains, at least for now, is 20%, right? We talked about whether or not that policy made sense. And then we moved on and we spoke about what is a capital asset, right? Code section 1221. All right? And we keep in mind, or you should keep in mind, that all assets, right, are capital assets. All assets are capital assets, with a few exceptions, right? A few exceptions. We said, by the way, getting back to chapter 6, just to remind people that losses must be realized, recognized, and allowed, right? Realized, recognized, and allowed. In contrast to gains, which must simply be realized and recognized. And allowed, we find in code section 165, right? And there's many loss disallowance provisions. So be careful with those. I might ask, is loss allowed? Because practitioners, I know, often miss that. So we looked at that, and we looked at what is a capital asset and the holding period. We know under code section 1222, it has to be more than 1 year. We also saw, yes, capital gains get a preference, but capital losses, there's significant limitations, right, with capital losses. With capital losses, under code section 1211, there's limits up to the capital gains, but for the first $3,000 that you're a non-corporate taxpayer. We moved on, and we saw that, hey, you don't lose those capital losses. Under code section 1212, there's carry forwards, or if your corporation carried back 3 years, carry forward 5 years. Right? We then, as we're going through chapter 21, we again looked at holding periods, we looked at judicial loss of the statute, we looked at correlation with prior transactions, right? That if you treated a transaction one way for tax purposes, if it was a related transaction, you had to treat it in the same form or fashion. Arrowsmith and Scully's Oil. We saw the authors gave us a whole series of code sections where sometimes Congress will go out of its way to treat a capital asset where none is created, or treat capital gain where none is created. Or the converse is true. When you might think it gives rise to a capital gain, Congress says, no, not so quick, and it results in ordinary income. For example, the sale or disposition of a franchise or trademark. Then we spoke about 1231 assets, right? 1231 assets. And I said that 1231 does come up with some frequency. Okay? Jesse, can you explain the general rule? You can just say the general rule. Or you go on if you want. Say it loudly.
They treat preferentially because if there's a long.
All right, say again.
It's treated as a capital gain, a long-term capital gain. If it's a gain and if it's a loss, it's an ordinary loss.
So what do you have to do? You have to, what do you have to exercise?
1231.
Yeah, what am I looking for in terms of making sure? How do you know you have capital gains? And I guess I'm not trying to be that cryptic. I was trying to hint at if you have to be patient, right? You have to wait until the end of the year, right? You have to see if your gains exceed your losses or your losses exceed your gains, right? And it's only if your losses exceed your gains, you get ordinary treatment. If your gains exceed your losses, you get capital, right? So, Luke, do you have one exception to that?
Yeah,
Just say it loudly.
if it's a like extraordinary nature, you can't control it. It's like the sub-hodgepodge.
Sub-hodgepodge. Now, code section authority for that.
1231 C. D.
Say again.
1231 C, I believe.
There's a few missing things there. Right? Anetta? Another? A4C. You got the C part, right, Luke? Just had to get the A4 part. All right. 1231 A4C, the sub-hodgepodge. And as I explained, that may result in even a better outcome, right? Because you can get, right, ordinary losses relating to this horrific event, even if your other gains are in the aggregate a gain. So you can have capital gain, and if it's in the sub-hodgepodge, it will result in an ordinary loss. But keep in mind, if the sub-hodgepodge has an overall gain, right? If you recall from the back pattern, the sub-hodgepodge has an overall gain, then there is no sub-hodgepodge, right? Congress does not feel that sympathetic. So the sub-hodgepodge disappears. Keisha, you want to explain the second exception to 1231? Keisha, you have it?
No.
You're not sure of it? Diana, do you have one? Not sure? Evelina? So say it loudly. Which one? The look back rule. Can you tell the class in general? Right, Nikisha? Evelina, what does the look back rule say?
You have to look back 5 years, and if you have a 1231 loss,
All right. If you look back 5 years and you have a 1231 loss, what do you have to do?
you have to aggregate.
What does aggregate mean?
Add them.
What does that mean, add them?
To add them, you have to add the losses and subtract it from your gain.
Does it change your numerical outcome in the year in question? What was that, Nick? Does it change the numerical outcome? Does it change the number?
No.
No, right? It only changes the character. Only changes the character. So, last time I'll do it. Okay, I won't do this again, but let's just make up a number, buy an asset for $50. Okay, just say that we're going to get to this, keeping it real simple for the moment. And if you take you sell this one asset, right, for 54, you sell it for 12, or you sell it for 8. Okay? Picture, if you will. You buy tractor for 50. That's your cost basis, right? You take $40 of depreciation, your adjusted basis is 10. And then you sell it, say, for $54. One section, you hear the word sale. Everyone knows that results in a gain. In this case, you might realize it's 54, the basis is 10, right? The gain is how much? Everyone can tell me? 44. But character is important. On an exam, don't tell me the character is gross income. Don't tell me the character is 1001. The character is, what would you, on an exam, what would you say the character of the 44 is, Alicia?
Either ordinary or 1231.
Just tell me which is what.
Okay, so 10 will be ordinary, no, 40 will be ordinary and 15, hold on. 54. 40 will be ordinary and 4 will be 1231.
Everyone hear that? There's a bifurcation, and we'll get into this more, but if it were sold for 44, the first 40 is what we're going to learn is 1245 recapture income, and the other 4 is 1231 gain. Right? The other 4 is 1231 gain, and we're not going to say if it's capital gain or ordinary income until we're patient and know that this were the only transaction for that year. We sell it for 12. Our gain is how much? 2. And the character here, in this case, would be Mike. The 2 would be 1245. 45 recapture income. So this would all be ordinary. And Lewis, if we sell for 8, any gain and loss?
Loss?
Loss of how much?
2.
2. Lewis, character. Don't worry, Ashley knows. Okay, so what's the character? This is the only transaction for the year. And join me, see if you agree.
I would say that it is an ordinary loss.
Joanne, would that be right? You would agree. Why? Because the losses exceed the gains, assuming this is the only transaction, right? All right? Nick, the other question?
I just, the prior first year, the $4 one, I can't read that word.
This, 1231?
It's just 1231.
Okay? Did this happen in 2016? These transactions happened in 2016? And let's just suppose 2014, 2013, 2015. Let me make up numbers. We had 8 loss, 12 gain, 8 loss. All right, these are all 1231 losses and gains going back. if that were the case, Ari, what's the character in 2013? Not sure, Dave? Dave? Character. It's Dave, right?
Yeah. It would be 1231 ordinary loss.
1231 ordinary loss in 2013. Hey, Dave, let me ask you a follow-up then. In 2014, what's the character? And then Brandon, see if you agree. I'll just write down whatever Dave tells me. Dave?
It would be
Just say it loudly.
in 2014, it would be let's say, 1231 gain for this aggregate total.
Say what?
1231 gain
12, or not 12.
of, I said 4,
Just say 4. What about the other 8?
because it's supposed to be aggregate total.
I'm sorry?
Because it's supposed to be aggregate total.
So how much would you instruct your taxpayer to report in 2014? 12 or some other number? Brandon?
The 8,000 ordinary gain, and then the 4 would be long-term 1231.
Katie, would that be right?
Yeah.
You're saying that almost with a question mark.
Well, that's what I was gonna say, so. I think you report the 12 and you separate it to the 8 in the form.
All right. Why would you do that?
Because you're looking back to 2013.
All right. So 8,000 casts a shadow, right, Dave? On this, the dark shadow of 8,000. So this we'd have to bifurcate 8,000 ordinary income and 4,000 1231 gain, right? Agreed? 2015, we have another 8,000 loss. Stephanie, how would you report this? And John, see if you agree. The 8,000, Stephanie?
Not sure.
I'm sorry?
Not
Not sure? John?
Just like the 2013 is going to be.
You're going to report as ordinary loss?
Yes.
Edward, do you agree? You're not sure? Alicia?
2015,
Yeah, 2015, what do we report?
$8,000 ordinary loss.
Why?
Zero rate of recapture 2013 loss.
Yeah, there's no taint and it's all going to be an ordinary loss, right? So what are we going to report in 2015 if we sell for 54? David, what are we going to report?
Sorry, 2015, what?
This is it. This is the only asset we sold in 2015. So given this happened in 2015 and this happened in 2016, what are we going to report in 2016? And ignore this. No, these two, just this one.
It's the same thing, and the previous year becomes ordinary loss, and then whatever's on top of that is 1231.
So how much, what are we going to do with respect to the 44? How much should we report and what's the character? Any thoughts?
Not many.
Nikisha, you have your hand halfway up?
I'm thinking ordinary income, because we have the ordinary loss for 2013.
All right, so Kavya is nodding.
He's 36,000 ordinary income.
How much are you going to report?
Both are income, right, on 2016, the 40 and the 4. One is
Right.
1231 and the other one is 40.
All right, so what are we going to report in
I
2016?
would take the 8,000 minus the gains.
So what would you report, numerically and character?
You can deduct the losses as long as you have the gains.
All right, but here's the problem. Jay, what's the problem?
You want to know the character and the
Okay,
numerical?
we're not going to change the numerical outcome, right, Jay? this 44 will be reported. The look back rule does not change, you're not carrying that loss forward. Right? You're not carrying the 20, this is not a net operating loss, it's a 1231 loss. No one said anything about it being a net operating loss, right? Nadia, it's not going to be carried forward. So Jay, what's the answer here? In 2016, what are we going to report?
40,000 ordinary income, 4,000, 1231.
What's the character?
44.
44 ordinary, right? This 4 is no longer going to be a capital gain because this is going to cast a shadow on it, right? You look back, this has been cleansed, okay? The prior years have been cleansed, but here's 8,000 and taint, and it's going to taint this 4,000, but there's still going to be 4,000 left to taint future years for the next 4 more years. Alicia?
So 12, 15, 8,000 ordinary loss is it results from 1231 loss, yes?
Yes.
Okay. But it would not result from 12.
Yeah, but it had nothing to do with 1231, then it would be 4,000 capital gain. Got it? You got that? These are all 1231 gains and losses, and that's why it's going to cast a shadow here, right? On the 1231 gains. Mike, you got that?
In the other words, there's 8, in 2013, there's 8 ordinary loss, 14, 12, then 8 again loss, so that's 4 loss plus 4.
I don't know if I want to say plus.
Yeah.
I mean, the word plus because it gets, I don't want people to change the numerical outcome.
Yeah, I mean, it's just to calculate 1231 first, so you would do minus 8 plus 12 minus 8 plus 4, so that's, or no, I mean, the
I don't,
outcome
I don't,
is 44.
and I don't tell you, I don't know how to tell you how to look at it, but you look back. And, I mean, the theory is you look back the prior 5 years and to the extent there's 1231 losses that haven't been used, and they're available. And here there happens to be 8. We have 4,000 again. 4,000 would be recast. And in 2017, let's just go one step further. Next year, we have 10,000, 1231 gains. Okay? And you guys know, right, Larry? You're shaking your head. How do you characterize that?
So there's gonna be a 4,000 ordinary income.
Right.
6, that's 1231.
Yep. So just make sure, because I know many people, students and practitioners, miss 1231C, and they hear client has sold a 1231 asset, and they instantaneously, we all want to be heroes, and say, oh, you're going to have a capital gain this year, lucky you. And they don't ask the right question. And clients perhaps report capital gain only to be frustrated and maybe get hit with a tax penalty. And who are they going to blame? Are they going to look in the mirror, guys, or are they going to look at you? Did you hit with a penalty? Did you paid? So just be careful. Temptation lurks here. We all want to be heroes to our clients. All right? So say it loudly.
I'm sorry, so when we look back 5 years, we include the year that we are working on, so we would take into consideration this 4,1231 section from 2016. Because we have to report 44 and 16, yes? 44
44, I don't know what you mean in 16.
So we were saying that there's this rule, section 1231 A4C. I'm sorry, not A4C, 1231C look back. And we look back 5 years.
Go back 5 years from here.
From here, so we include 2016. And
No, 5 years, look back 15, 14, 13, 12, and 11.
Not 16.
Yeah, that's not a look back, that's the
That's not a
current
look
year.
back, that's
Right? All right.
And one more question, just because sometimes throughout the textbook you can read about real property and personal property.
Yeah.
So I feel like it's a little confusing sometimes.
The authors use it because there's regulations that have been since repealed under Code Section 47 that refer to personal property. Real property is buildings for our purposes, okay? And everything else is just generally property, called personal property or what. But generally, and we'll see when we get to depreciation, that generally holds true. And we'll see that with respect to Code Section 1245 and 1250, okay, momentarily. Right. So, guys, that generally brings us up to date on the material that we covered today, too. Before Warren will be on the exam as well. So, hopefully I'll keep you guys awake tonight, so you'll know that it's on the exam. Let me just ask a question or two logistically. Periodically, as I think you know, and I apologize if you saw too much spam from me today, I apologize, but periodically I do get these very good job offerings that I feel remiss if I didn't share it with you. So you hopefully all saw the job offerings. And then in addition, I am still promoting for those interested, final week, not for this Saturday, a week from Saturday, this murder mystery and tax education that I'll be moderating. So I will not be like Anderson Cooper last night. I'll try to keep I hope it will be even more fun than the debate you saw last night. But that's going to be a hard benchmark to meet, entertainment-wise. Although, you ever feel like you want to jump through the TV screen and shout? And they're asking Hillary and Trump about, Donald about how would they tax the wealthy? And if you could tell, I'm sure you guys want to jump through the TV screen too and say, guys, you know more than they know about the tax code, undoubtedly, at this stage, because they only spent about 15 seconds, in my opinion, answering that question, and then sort of had their own agendas. Not surprising. Anyway, anything else before we move on? Logistic-wise, I am around this entire week. So if you do have questions that are related to tax that you're losing sleep about, just find me. And I try to be very religious about returning emails. If I don't get right back to you soon thereafter, give me a 6-hour window period. Just send your email again. Don't be embarrassed. Just put high priority. Just make sure the subject line again. You put student from Monday night class. That's very helpful, and those usually get my first attention. Okay. Question.
Going back to this question, I think I understand it. So we only have 4,000 ordinary income because we used the 4,000 in 2016 from that age.
But you mean this year?
From 2017 it's 4K, and 2016 it's also 4K.
I don't know what you mean by 4K. Be careful. The taxpayer is going to report 44,000 of ordinary income.
But we're only taking that 4 and looking at the loss. I was saying that 4,000 will become ordinary.
This 4,000 of otherwise capital gain becomes ordinary income.
And that's why you only have 4 left to bring it to.
Yes, that's why we only have 4 left, because in 2017, when we look backwards in the rearview mirror, there's only 4,000 attained that remains.
Okay, thank you.
All right? All right? Anything else?
So when you say that, though, all the prior years net to zero.
Net to zero, that's what I was thinking, so I wasn't.
When you say nets to zero, I don't know what you mean by nets to zero, because this is zeroed out here. Okay? What I mean is there's no carry forward here. There's no carry forward. I mean, this is 8,000 attained. This starts anew.
Oh, because I thought we do.
No, we already absorbed this 8,000.
Yeah. Oh, I see.
So when we look back, we only have 8,000
Oh,
of
okay,
attained.
so there's this 8 impacting 16, 4 and 17, another 4.
Mike, you got it? You're not sure? And again, one more time, when you look, I'm going to, by the way, if you don't mind, some of the best way to learn this is to have someone teach you or vice versa. Alicia, over the break, if you can, talk to Mike, because you seem now like you're comfortable, or Anna, See if you can explain it, Mike. If they can't explain it to you, I'm here. And it's a very good exercise to see if you can explain it to someone. Because that's reinforcement for you, and hopefully they learn this. I will not erase this. All right?
So we carry forward the law until we.
Don't say carry forward the
No,
laws.
that's not a good word.
That's not a terrible word, if you don't mind me saying. All right? The taint remains. Okay?
Until we absorb it.
Right, because if people hear you talk to a client, you get to carry forward. Clients run with the ball. Give them an inch and they'll take 100 miles. So just be careful about your terms of art. Right? And particularly, forget about Hillary in the email exchange. You have it worse. Whatever emails you send to clients will not be deleted, I promise you. And if there's a problem, your client will find that email and will pin the blame on you, okay?
So
I don't get it, by the way. Donna was talking about that she bleached her email. What am I missing? No, seriously, was that a term that was used last night?
I heard it.
But I didn't know what it meant either.
Okay, you guys are supposed to educate the older guy here. Sanitize, but he kept talking about the word bleaching. Excuse me, I think of laundry and bleaching. I don't think of emails and bleaching.
I have one more question.
Go ahead, Anna.
He also was talking about the carriage interest and said how it is impacting on the
But you guys have the softest voices imaginable, okay? So can you guys, just so I am sure that people way behind you, like Jackie, probably didn't hear that, right?
So he was talking about carried interest yesterday, and he said that, you know, he pays a lot of taxes because of
Notice he's very careful, by the way, when he says he pays a lot of taxes, okay, we all pay sales tax when we buy a car. We all pay property tax if we own property. I have no clue, nor do you, if he pays any federal income tax. All right, so I'm sorry, keep going.
But also when he was talking about carried interest in relation to his business, I mean, he has the real estate. Carried interest does not impact real estate.
No, carried interest indirectly does. I mean, hedge funds could invest. I mean, I don't think he's a benefactor of carried interest. His point was Hillary should have closed the loophole regarding carried interest. She wasn't president. I don't quite, there's a lot of things she should have done, but she's only one person. You've got to choose your battles. Believe me, I had my problems with Hillary last night too. She would have to be instructed. There's probably 2 or 3 pet peeves I have with Hillary. She had to fill every 2 minutes. They kept saying, okay, after a minute, you answer the question, move on. You don't have to take the full 2 minutes. Second, stop smiling. Every time he said something, and even if it was infuriating, you don't smile. And third, she kept saying, go check on Hillary.com. Enough with Hillary.com. Right. And then obviously I had my problems with Donald too. So, but those were we all had different issues, I'm sure, as the night unfolded. It was not the most glorious moment in American politics, right? Train wreck is probably characterized. Speaking of character, Luca.
I have a related question. I was reading in the New York Times about the accountant who did the tax reforms. Was he allowed to talk about that stuff that he was talking about?
You know, on Saturday night, that's what, believe it or not, I was talking about around it was called gourmet dinner. It's just a bunch of neighbors getting together for dinner. And that's my excitement is to talk about, I think his name was Bernie, the guy who accounted, who was 80 years old, who should not. If people read the article, the New York Times went to him and said, did you prepare these 1995 tax returns? And he said yes. And he said that the computer had a flaw back in 1995. It couldn't go up to 915 million. So with his Smith Corona typewriter, he had to type in the 91 because it was just too large of a number. And it was a big ethics issue whether or not he should have done that. My understanding, the backstory of that, is Donald Trump ripped him off royally, never paid his fees. So this was his touche to Donald.
That's not surprising. Donald Trump does stuff like that.
Well, again, so that's the backstory. But to answer your question, you probably should never. I mean, he would have risked his license. Here, he probably is retired and doesn't have a license or doesn't care at this point.
Yeah, I actually heard him speaking. I just forgot which channel.
Right? So-
He gave an interview, but he was
Yeah.
very, I mean, he wasn't very talkative,
No, he's gonna be careful,
very careful.
somewhat careful. If he was very careful, he would have just said, Donald who?
And now Donald Trump is calling out all these other people like Warren Buffett who use the same type of tax strategy.
The tax strategy is not the issue, because there's no problem in my book not using code section 172, right? If you wanted to have a net operating loss, why wouldn't you? The question is, you can't be an extraordinarily successful business person and not pay any taxes, type of thing.
In case some haven't seen it, Warren Buffett put out a statement, he says in 50 years, whatever, he's never had a carry forward loss.
Okay, I didn't see that statement, so, Brandon.
Yeah, back to this point, we actually have to write an essay whether he I guess did anything ethically wrong. I feel like he just said that he signed the tax returns. I don't know.
Did you put it?
The accountant.
But you're not even supposed to say who your client is, or certainly even in detail about filling out the return.
Yeah, but it was released from his camp. Like he just gave
Whose camp?
Trump's.
That was never released. That came in a brown paper envelope to the New York Times.
No, what I'm saying is the guy, his name was Jack Mitnick, the accountant, just said that he gave the tax returns to Trump. That's it. So 20 years, I guess from now, it comes out, and it has his signature on it, it has Trump's signature on it. All he said was he signed it.
I mean, again, he probably said, yeah, that's my signature. I don't know. I didn't see
Yeah, that's basically what he said, and then he confirmed there were losses there, but he didn't even clearly state how much.
The information's already out there.
Yeah, I mean, it's probably, I don't know. Say again, Ashley?
I was saying, once it wasn't confirmed that it was Trump, so once it's officially confirmed that it does reveal confidential information about Trump, it could have just been a fake tax return.
All right, guys, let's get to 3 different. I think because I could spend all night. Everyone could here. I think, correct me if I'm wrong. On page 823, did we finish problem 2, 3, problem 2 and 3? Yes, no. All right, so let's finish this and then finish chapter 22. And that will put us in good shape for the exam, all right? Ready? All right. So question 2. Car dealer uses some cars for demonstration purposes. Are the cars depreciable? Disregarding code section 12.5, they are held long-term as gain on their sale qualifies for 1231 main hodgepodge. Right? So that's the question. I don't know, did anyone recently buy a car? Anyone buy a new car in the crowd? No one? Oh, Tina, if you bought a new car, is that a 1231 asset if you took a test drive and you bought that car from the dealer? Is that a car that you took a test drive and then you bought? Is that a 1231 asset? Or is that something else, Tina? That's what, you have your whisper voice on, Tina. It's 1231 asset. Why do you say it's 1231? Why might you say it's 1231 asset, Zach?
Inventory?
Well, is that making 1231 or some other kind of asset, Jay?
Well, I thought it's not 1231 because it's inventory.
All right. I mean, you could say on one hand that it's an asset used in a trade of business. The person took Tina for a test drive, right? But it's more likely to be characterized as inventory, right? Because if Tina wanted to buy that new car, guess what? The showman or salesman was going to say, Tina, I'd be happy to sell you this car. So it has a stronger aroma of being inventory, right? And to be a 1231 asset. Accordingly, it is not depreciable, and any gains on the sale, right, would just give rise to ordinary income, right?
Even though he says, well, the question says the car is used for demonstration purposes?
Because it has a foot in both worlds, right? It has a foot in being a 1231 asset, but it has a stronger foot in being inventory, right? Because as soon as they use those test cars, they want to sell them, right? Question 3. Merchant who's been in business for 40 years, sells or sole proprietorship consisting of the following assets, all of which, except for inventory, have been held for more than 1 year. We look at the assets. We see merchant also agrees for an additional $20,000. So will not compete in the same geographical area for the next 10 years. Okay, and we call that a not-compete clause, right? Disregarding any consideration of 1245 and 1250, which are considered in the succeeding chapters, what if she sells her business for $140,000 in total? If you take 2 minutes, I'll try to keep my mouth shut, and come up with a computation of the total gain or loss and the character, okay? Take 2 minutes if you haven't done so already. Take 1 more minute. All right, so Louise, Joanne, Jesse, what do you guys say? Louise?
We started from inventory.
I'm sorry?
Inventory.
Okay. And by the way, Joanne, Jesse, chime in if you think Louise is going off here. So inventory. What would you tell the client to report? Louise? So what would you tell the client to report if you're selling a business?
16,000.
16?
16,000 inventory.
I'm talking about what would you tell them to put on the tax return, please?
Within, building,
Okay, how much?
the fair market value, inventory fair market value, goodwill, the fair market value, and the land.
All right, let's stick with inventory. How much are you going to tell them to put on the tax return?
16,000.
Joanne?
Maybe 8,000, 1231 gain.
Jesse, agree or disagree? Not sure. Brandon?
I had, 8,000 for ordinary gain for inventory.
All right, guys, it's inventory.
You don't have to approve it.
It's all ordinary income, right? Under code section 1221, it's not a capital asset. Louise, you're not gonna put down 16,000. Under code section 1001, you're gonna take the amount realized, 16, the basis of 8, and you're gonna compute the gain of 8, right? Right, Louise? So you would reflect the inventory, $8,000 ordinary income. All right, Zach, what about goodwill? To here.
Ordinary.
Zach, already agree, disagree?
I agree.
Great, Dave, final word? Go ahead, the buck?
No, I left home by accident.
Oh, Katie? No? Stephanie? Agree, so what's your final answer, Stephanie, and why?
20,000 ordinary.
And Stephanie, why do you call it ordinary? What kind of asset is it? You're whispering, which is never a good sign if I'm a client. I get nervous when my professionals start whispering. Right, Mike? You get nervous, wouldn't you? What kind of asset is this, Mike?
This is the one I'm not sure about.
This is a capital asset, guys, not a 1231 asset. Goodwill is not depreciable. It is not real estate.
It's intangible.
It is intangible. You can't touch it, right? This is not purchased goodwill. This is self-created goodwill. It's not advertisable.
Oh, yeah, it's a capital asset.
Busto, can you say that louder?
It's a capital asset.
Capital asset. Thank you. All right. Land. All right. You. Karen. Jackie. You. Start us off here. You're not going to start us off? On land? Jay, your hands up?
I said 10,000 long-term capital loss.
Okay. Johnny? You agree? Johnny? Not sure? Oh, Jackie, help us out here.
Yes,
Guess what?
it's 10,000 loss.
Okay? What character do you put on it?
Not sure.
That's important, right, Jackie?
Yes.
Would it be fair on the exam if I ask that? So next week you'll know? You won't get mad at me if I ask? You might get mad, but is it going to be my fault or your fault? Alicia?
I would watch the land building and machinery equipment, and then figure out if the gains exceed the losses.
Ah, so Alicia says these are all 1231 assets, and Alicia being the patient person you are, right, Alicia? People refer to you as patient, right? Maybe not?
I don't know.
All right, well, I'll tell you I think you're a patient person, okay? I don't know what others say. I say you're patient, okay? And that being the case, let's be patient. Let's hold our hands. Let's do these three assets together. On the machinery, G. Ying, gain or loss? On the machinery, is there a gain or loss?
Gain,
Gain of how much?
2,000,
How much?
2,000.
How much did you have?
Yeah.
Yeah,
You skipped the building. Oh, I skipped the building, you're right, I did skip the building, I'm sorry. Let's go back to the building. Building, G.
15,000.
15, right? Thank you. So G, I can't take it away from you on the equipment and the machinery and equipment. Gain or loss, G?
Gain,
Gain of 2,000, right?
Ordinary income, right?
What was that, Diana?
Ordinary income.
Katia says ordinary. Diana? Evelina say what?
The 2,000, but it's machinery, it's like inventory.
Is it, what kind of asset, Katia, is it?
Ordinary income.
What kind of asset? You didn't tell, you're telling me character. These three assets are 1231 assets. Machinery and equipment is not inventory, Katia.
I'm pretty sure you said machinery, inventory, and something else.
Not me.
Not you.
Different
person, different class.
And even if I did, I'd be dead wrong. That's actually 1221. Take a look at it. It's not Jay Solar that dictates the outcome. Okay? All right? Just be careful what you're drinking there. Make sure it's not.
Just coffee.
All right, make sure it's not decaf. All right? These are all 3/12/31 assets, right, guys?
Wait, the bottom three?
Bottom three. They're all assets used in a trade or business, right?
1221. Machinery, inventory.
As an exception.
And I can't
It
receive-
falls, those assets are 1231 assets.
Yes.
Yes.
Oh,
Well,
yes.
right, that's a bad mistake to make on the exam.
Okay.
Very bad. And that's a bad mistake to make in practice. Very bad. Right? All right. So, the character of these gains and losses. Jeff.
Capital.
So should I put capital loss, capital gain, capital gain? Would that be correct, Nick?
Yes, because the gains exceed the losses.
Right, the gains exceed the losses. All right? Everyone good? That's an important question. This is very similar for your notes to the Williams v. McGowan case, right? Williams v. McGowan said you had to go asset by asset by asset, right?
And the non-compete will go after us, but not.
The what?
Non-compete.
Non-compete. We took care of $120,000 worth of assets, right? How are we going to treat that $20,000 non-compete? How are we going to report that for tax purposes? Alicia, you say treat it how?
I was treated as capital asset, but it's depreciable.
Treat it as capital asset? Aneta.
I think he's only getting money, wouldn't that be just income?
Well, it's income, but the issue is what is the character of the 20,000?
Would it not be ordinary?
It's not selling it, you get a here's $20,000 cash.
If you get paid $20,000 to perform services, how do you report that? Ordinary income. What's your authority? 61. If you get paid $20,000 to sit on your tush, how are you going to treat that? Thank you. Ordinary income.
To take that a step further, could you not claim portions of that over the next 10 years?
How can you not if you physically get it?
What I mean is, instead of, could you not just do $2,000 a year over the next 10 years, since it is for 10 years? Or no, you have to
If
pay
you're a
all-
cash method taxpayer
No.
under North American Oil, you got it, you have a claim of right to pay tax. Yeah.
Two. Okay.
There's no sale or exchange for that. It's a payment for non-services. Okay, we're gonna see the Williams v. McGowan angle to this. Okay, and in that case, the court rules you have to go asset by asset by asset. Question B. What difference in result in Merchant's business had always been incorporated? She was the sole shareholder. She has a $90,000 basis in her stock, which she sells for $120,000. Assuming again she's paid an additional $20,000 for her covenant not to compete. So someone comes and offers her $120,000. Karen, what do you recommend to hear? See if you agree with Karen.
So the difference is she's incorporated, but that's it? All right, I'm gonna say then, I guess I'd say then capital,
Here, you want to say, then Karen?
okay, sorry, yeah, I'm just gonna say 30,000 capital gain and 20 equipment.
Yeah, I agree.
Okay. Tina, final word. You don't know? Stephanie? Agree. Why, Stephanie?
1231.
What if you have the basis at 1231? Does 1231 have any role here, Larry?
No, so there's a 30,000 capital gain on stock because the stock is a capital asset.
Right, the stock is a capital asset, right? It's going to be nothing to do with 1231. So the stock, we have code section 1001 apply. We have a gain from the sale or disposition. Amount realized is 120, basis at 90, gain of 30, capital gain, and then we're paid an amount not to compete. That's all ordinary income. All right.
I have a question for A. So if the goodwill is acquired goodwill, what's going to happen? So what is the difference between the self-developed goodwill and the acquired goodwill?
Well, if it's acquired goodwill and it's amortizable, that's going to possibly be used as an asset. It could be made into a 1231 asset. This is an asset now used in a trade or business, which is amortizing. Right? All right. Ready to move on to chapter 22? Code section, or chapter 22 has 3 code sections as part of here. Code sections 1239, 1245, and 1250. None of these are good for the taxpayer, I'll say. None of these are particularly good for the taxpayer. 1239 doesn't come up with that much frequency. 1245 comes up all the time. And if you're in the real estate world, code section 1250 does come up. So 3 different code sections to add to your repertoire. I've said it before in this course. I'll say it in most of the tax courses. Anytime there's transactions with related parties, your antenna has to go up. Okay? Anytime there's transactions with related parties, your antenna has to go up. You have to be sensitive to what's going on. It's It's not easy. When I say it's easy, it's not easy. Congress is unnerved. And we have this case, US v. Parker, which is sort of emblematic of Congress's concern. Okay? And it's to demonstrate the mechanics of Code Section 1239, US v. Parker. All right. Any volunteers? Wes, we haven't heard from you. So maybe it's been instant volunteer. Do you remember what happened here?
Yeah, wasn't like Parker, so, I think Parker formed a business and Parker was provided, he had good shares and he was provided senior shares.
Okay, so Parker has a business and he's an 80% shareholder and there's another minority shareholder who owns 20%, right? And what does Parker do that's important for the tax issue?
That he, in accordance with the he owning exactly 80% of the corporation.
He owns 80%, but what does he do factually that triggers, Luca, that triggers this case?
Sold to the corporation certain other assets which are depreciable property.
All right, so picture if you will, this could happen. You own 80% of a company and you sell equipment and other assets that are depreciable by the corporation that you're selling to. So you own 100%, or in this case 80%. Okay? So here's the corporation. You own 80%, someone else owns 20%, and you sell in a sales transaction to the company depreciable equipment. And Wes, what is Congress concerned about regarding that sale? What is the congressional concern?
I think what they're concerned about that you will sell the asset that was already depreciated once and you will want to depreciate it again.
All right, so everyone hear that. You depreciated it once, okay, got ordinary deductions. Congress is concerned that you might try to depreciate it a second time. But the big issue here is when you sell it, you'd like to report capital gains taxable at a low rate, and then in the hands of the corporation, depreciate it and command greater rate. And this is reflected in footnote 1 on page 827. Everyone open that up if you could. Footnote 1. The net effect may be shown graphically in a hypothetical case. The transferor R owes property depreciated value of $2,000. R sells the property for $6,000 to E, his controlled corporation. R pays a maximum capital gains rate of 25% of the $4,000 gain for a tax of $1,000. E, with a basis of $6,000 of the property, takes depreciation deductions from ordinary income. After 4 or 5 years of these deductions, E has depreciated the property back down to $2,000. E has then deducted $4,000 of depreciation from ordinary income. If he's in the 50% tax bracket, the $4,000 of depreciation has saved him $2,000. Art has therefore paid $1,000 of capital gains and has saved $2,000 of taxes. If R and E are identical, in the case covered by 1239, they may certainly consider to be so. Then R has avoided $2,000 in taxes by only paying $1,000. Bottom line is this, guys. If you found that hard to follow, if you could sell an asset to your alter ego, this related company, pay gain on $4,000 and pay $1,000 in tax, right? The assumed capital gains rate at 25%, okay? It's paying $1,000 in taxes. And meanwhile, even though there's a time value of money issue, take $4,000 of depreciation and save $2,000. That's not a bad deal, right? I report $1,000 today, or pay $1,000 today, if I could save $2,000, albeit over the next 4 years, even with the low interest rates, that's really gonna be worth close to $2,000. So that's a home run, right? Pay capital gains rates and get ordinary deductions. Where do I sign up for that? Where do I sign up for my clients, right, guys? So Code Section 1239 says, look, if you try to sell to your alter ego, that doesn't work. We're going to say, instead of getting capital gains, we're going to treat it as ordinary income, right? So instead of getting capital gains, you will get ordinary income treatment. Nick?
Yeah, the only thing is though, if you sell it, then like, how is it a capital asset at that point? If you're
So
selling
when you say
trucks
it's
and
not a
machines.
capital asset, it could be a 1231 asset, it could be a capital asset. Doesn't matter, it's going to give rise to ordinary income. This trumps the ordinary, what you would ordinarily classify it as.
Okay.
Okay, this forces it to be ordinary income. Army says you sell to your alter ego, we're going to force ordinary income treatment. All right? Joanne?
Wouldn't that still be the case from the example on the board?
Because of 1245 recapture?
Yes.
But suppose you sold an asset, like a car that you used for personal reasons that you never depreciated in your house. It's a capital asset, right, a car? And you sold it even at an inflated price. Your company overpaid. It's a boondoggle to you. Because you're essentially getting a tremendous tax write-off in the hands of the corporation.
Okay, but in this particular case, the gains will be 1245.
Well, we don't know. We don't know. I mean, in this case, it would, okay, admittedly, John, that would be in the fact pattern the judge described. But if they sold for an amount above the depreciation, it'd be 1231 and possible capital gain. So you're absolutely right. I think, again, for illustration purposes, the court kept it simple and ignored 1245 recapture, which we'll get into. All right, so 1239, let me remind people, does not come up every day, and that's what makes it dangerous, right? Because maybe 3 years from now, 8 years from now, 12 years from now, if I calls you up and says, listen, I have this capital asset, I want to sell to my corporation, and I assume it's going to be capital gain treatment. And again, we all want to please our clients. We all want to be loved, right? Having said that, you think you're going to 1245, you'll probably remember because you're working with it all the time. 1239 is a dangerous code section. It's a landmine because you don't see it too often. But the only thing I can remind you, anytime, guys, you may not remember 1239. But I say it to you because I want to remind myself. Anytime you hear a related party transaction, you may not remember the code section, but don't think you or your client is so smart, you're the first to have thought of this idea. That's all I warn you about. And think, I better check. There might be something brewing in the code or regulations that does not yield the same favorable tax treatment. Now, when you read this case, Wes, it talks about the taxpayer here owned 80%. Did this surprise you? Did the authors of this case get it wrong? Because when you open up to Code Section 1239, everyone should open to Code Section 1239. It talks about 1239A, says treat the gain as ordinary. Who's a related person? That's 1239B. It says a person in all entities which are controlled entities with respect to such person. And if you look at control, that's 1239C. Controlled entity means a corporation more than 50% of the value of the outstanding stock which is owned directly or indirectly by or for such person. Wes, what's wrong here? I mean, in the case, you kept emphasizing, right, Luca? More than 80% of the value. So why the discrepancy? Right? Doesn't the case in Parker keep referring to more than 80% of the value? Larry, you're...
There was a change of law in 1976.
All right. that the law was changed, right? This case is decided under prior law, where the old law used to say for 1239 to apply, you needed more than 80% of the value. And has the law become liberal, more liberalized, more likely to apply, Larry, now, or less likely to apply? Larry?
Can you repeat the question?
Is 1239 in the year 2016 more likely to apply or less likely to apply? And Fausto, see if you agree with Larry.
I think
More likely to apply, Fausto, more likely or less likely to apply? 1239.
Yeah, that's.
More likely to apply. Jessica, you agree? More likely? Yeah, it's more likely that people own more than 50%, and more people own more than 50% than do people own more than 80%. Agreed? All right? Still, remember our case. Our taxpayer, right, Wes, owned, let's assume there's 100 shares. Our client owned exactly 80, right? Everyone agree? Owned exactly 80. The other shareholder owned 20. Okay, what gives?
He didn't.
Tax. Say again, Nick?
He didn't completely own 20. He withheld some of the stock, and the taxpayer actually had control more than 80% of the company.
Well, okay, but in the name, the taxpayer technically only had 80 shares. The other shareholder, there may have been some shares held in escrow, but he definitely owned 20 shares or 20%. Our taxpayer didn't own more than 80% of the shares. Alicia?
More than 80% or 80 or
It's,
more?
no, it said more than 80%, but here's the next thing it said, of value. It didn't say of stock, it said own more than 80% of the value. So, let me ask you guys a question. If I own a company, I own a building, it's incorporated, and it's worth $1 million, okay? The building's worth $1 million. I own 80%. And Louis, you own 20%. Jackie, how much are you going to offer for Louis's 20%? Gia Ying, see if you agree with Jackie. Come up with a number you're going to offer Louis for his 20% interest in the company.
Well, it's worth $1 million.
The building's worth $1 million. How much are you going to offer Louis?
200,000.
200,000. Gia Ying. And remember, Solid's the other 80% owner. How much do you offer Louis? 200,000, Gia Ying?
I agree.
You agree? Jay, you too? Nick, you gonna offer 200,000?
You said the building itself is worth $1 million.
The building itself, and Louis owns 20%, Solid owns 80%.
And all I'm purchasing is part of the building? I'm not trying to.
No, you're purchasing the stock, but you're gonna purchase the 20% for 200,000. The answer is?
I don't know that I would.
Alicia?
Less, I would go lower.
Less. Because being a minority shareholder ain't no ball of wax, right? Because Solid's not such a nice guy. I mean, I can dictate, whatever the rental income, I'm going to pay myself a hefty management fee, right? Okay? And Louis, you gonna have any word to say about that?
Nope.
Nope. So buying a 20% interest is not a lot of fun, right? And it's worth typically a lot less than the 200,000. Depending on the circumstances, it might only be worth 150, maybe 100. Conversely, how much is Solid's at 80% interest worth? More than 80%. Because I'm king. I get to call the shots. I get to call it, there's a control premium, right? I can decide when to sell it, when not to sell it, and to whom to sell it, at what price to sell it. So, even though I only own 80%, do I own more than 80% of the value?
Yeah.
Yes. And notwithstanding, you got to be careful about getting involved in business transactions for your clients. Many of your clients will turn to you, their trusted accountant, and say, hey, do you think the price I'm paying for this is the right price? Right? And you got to be careful because if they, you know, I would be careful about putting that in writing. It's okay informally to tell the client, you know, maybe or maybe not. But remember, you're not an expert at evaluation, so just be careful if the client pushes you too hard. Because if they subsequently think they overpaid, again, your neck may be on the chopping block. But for our purposes, 1239, it's an examination of value, right guys? Value. And, go ahead, Alicia.
So for the purpose of technically what the code section says now, it's more than 50%. If you own exactly 50% of the value.
Well, we're going to get into that with the problems. Hold that thought. Parker, guess who wins, guess who loses? What? Say again, Nick? Parker loses. Taxpayer loses. Why? Hey, he's deemed to own more than 80% even though he owns 80% of the stock. He owns more than 80% of the value, right? Right. All right, so taxpayer loses. And the authors, in the opinion on page 829, describe the restrictions on the stock, the lack of control, all the reasons why his interest is inflated and the minority shareholder's interest is deflated, right? Look at the problem on page 831. Depreciator is the shareholder of Redepreciation Corporation. It owns 20% of its stock. Depreciator's spouse owns 10% of the stock, and their adult son owns 10%. The remaining stock is owned by an unrelated person. In the current year, Depreciator sells to Redepreciator for $110,000 of building use in Depreciator's building and depreciated on the straight line method with a $40,000 adjusted basis and $80,000 of value, and land underlying it with a $10,000 adjusted basis and $30,000 of value, both held by the depreciator for several years. What kind of asset is the building? Is it a capital asset or non-capital asset? Non-capital. It's a 1231 asset, caveat. It is not a capital asset. Okay? So, we have a little picture here. Depreciator, depreciator's spouse, and the son. And we have building and land. In question A, if you notice, the building, is there any gain on the building? $20,000, right? On the land is how much?
20.
And the land is 20, okay? And depreciator owns 10%, depreciator's spouse owns 10%, the depreciator's son owns 10%. So how much, what percent is depreciator deemed to own?
40.
Say again?
40.
40. What's your authority for that?
1239 E.
Say again?
1239
I don't think you need to look at E. I think you need to look at code section 1239 C2. It says, for purpose of this section, ownership shall be determined in accordance with rules similar to 267C. So let's look at code section 267C. For purposes of determining and applying subsection B of the ownership of the stock owned directly or indirectly by a corporation, partnership, estate, or trust shall be considered as being owned proportionally by the shareholders, partners, or beneficiaries. And C2 says an individual shall be considered stock owned directly or indirectly by or for a member of his family. Who's a member of a family? In this world, look at C4. The family of individuals shall include only his brothers and sisters, spouse, ancestors, and lineal descendants. Okay.
So
267C is your constructive ownership. So depreciators deemed to own 40%. So the answer is in A, is code section 1239 applied? Is code section 1239 that Luke? Is it applied?
No.
Why not?
It's more than 50%.
What is it?
40%.
No, it's 40%, 1239 does not apply. So this would give rise to 1231 gain and 1231 gain. Okay, everyone good?
Yes.
I'll just point out, because we're going to get into this, this would actually be 1250 gain. Okay, but we'll get into that in a few minutes. But the land would be 1231 gain. Question B. What result if the spouse owns 20%, son owns 20%, the remaining is owned by an unrelated person? By the way, here does 1239 apply? Yes, right? Because what's the depreciator deemed to own? 60%. Okay, everyone agree? Depreciators, the first problem is deemed to own 40%. Here, depreciators deemed to own 60%. Now, what does that mean? The 40,000 would be treated as what? Ordinary income. What about the land? Land 1231 gain or 1239 gain? Not depreciated. Look at 1239A. In the case of a sale or exchange of property, directly or indirectly, between related persons, any gain recognized as a transfer shall be treated as ordinary income if such property is in the hands of the transferee. Who's the transferee here? The company, right? The purchasing company is the transferee, right? Of a character which is subject to an allowance for depreciation provided in Code Section 167. Keep in mind, right, guys, that land is not depreciable. Congress was not concerned from a policy perspective if you sold land to a related person because the gain expressed in footnote 1 couldn't be played, right? You couldn't get a capital gain and then get ordinary deductions because land is not depreciable. So this would remain, on the land, it would remain 1231 gain. Everyone see why? Again, no gains could be played. No gains could be played. Question C. What result if spouse owns 10%, spouse's brother owns 10%, hold on. If spouse owns 10% of stock, spouse's brother owns 10%, son owns 20%, the rest is owned by an unrelated person. So the spouse's brother owns 10%. I think spouse owns 10%. Everyone have it? Depreciator owns 20%, spouse owns 10%, son owns 20%, spouse's brothers owns 10%. So does 1239 apply here?
Yes.
Is that a yes, no? I heard both.
Yes.
Jay, you say yes. Why?
Because it still adds up to 50% being direct or indirect, and
How much is depreciator deemed to own?
20, I think, right?
Well, he owns 20 directly, but how much constructively? You have to look back at 267. Here's the issue. He owns 50%, right? Is he deemed to own his brother-in-law's shares? No. Why? If you look at code section 267C5. Code section 267C5. It says, stock constructively owned by reason of application of paragraph 1 shall, for purpose of applying 1, 2, or 3, be treated as actually owned. But stock constructively owned by an individual by reason of paragraph 2 or 3, that's family attribution, shall not be treated as owned by him for purposes of, again, applying either of such paragraphs in order to make another constructive ownership. In other words, family attribution rules you can't use twice in a row. Why? Because, let's face it, everyone in this room, myself included, we're all related, right? Just have to go out far enough and we're all related. So what Congress says is you don't go from here to the spouse and then constructive ownership again. All right? Because again, if that were the case, everyone would be deemed to own constructively everything. And the truth is, you may not get along with your sister-in-law or brother-in-law, right? As a practical matter.
So, taxpayer and spouse, they're not considered one unit.
Well, the spouse is considered one unit with the depreciator, but you don't attribute the shares to spouse and then back to depreciator. There's no double attribution.
Unless it was the spouse actually selling the assets to the corporation?
I'm sorry?
If it was the spouse selling the assets.
If the spouse was, then there would be a problem. Right. John?
Wouldn't they be filing the same tax return though?
Doesn't matter. I mean, depreciators deemed to own 50%. My question is, does 1239 apply here? Does 1239 apply? Nick?
Wouldn't he also not count for 267C4? Because he's not in that line.
Well, he
brother-in-law?
isn't. The brother-in-law definitely isn't included in C4, but that's a different issue. The question is, the spouse is deemed to own her brother's shares.
Oh, I see what you're saying.
You then, once it's constructively owned, it's almost deemed actually owned, but there's no double attribution.
Oh, I see.
All right, but that doesn't answer the question. Does 1239 apply if the depreciator sells this depreciable equipment or depreciable building to this corporation? Luca, yes, no, maybe?
I said no because it says more than 50%, this is just 50%. I said no.
Renata, is great. Alicia? Busto? Let me ask you a question, guys. Suppose this were Microsoft. Well, Bill Gates owns Microsoft, right?
Yes.
Right. Let's just suppose he owns 50% and us, the public, owns the other 50%. Does he own more than 50% of the value? Don't say the word probably. Yes. Okay? So, if you saw this fact pattern, you would want to ask another question, right, Luca? Which is what?
What is his value?
Well, what is his value and who owns the other 50%? Suppose spouse's brother's wife owns the other 40%. Then this side of the family owns what? Probably 50%, exactly. And this side owns 50%. But if this side is owned by 1,000 or 100,000 people, and they own 50%, they own more than 50% of the value. So, sorry to make your notes ambiguous, but question C could go either way, depending on who owns the other 50%, right? Go ahead, Brandon.
So this is like applicable if like the people, the individuals are kind of trading like amongst businesses? Because
Well,
they
this
won't
is
take a-
related parties. It's Brandon, you control the corporate entity, and if you sell depreciable equipment to it, you may not command the capital gain treatment you receive.
But you can't depreciate as an individual, right? You have to.
Well, I don't know what you mean you can't depreciate.
Are
You
allowed-
sell, go ahead.
Are you allowed to depreciate something without a business?
Well, no, but you're selling it to a business, that's why it's depreciable.
No, I know, I'm saying that would come up, like, when you look up the relations of a family. If, I guess, the depreciator has a business and then he's selling it to another business where he's involved in the stock.
I don't know what you mean, the stock. Is he selling a business in which he controls it?
Yes.
And does he own more than 50% of the value? You'll answer your own question.
I know, okay, all right.
Think about it. Question B. What resulted B above if the sales made by other corporation in which depreciator owns 100% of the stock to redepreciation? Okay, so we have, if you recall our facts, depreciator owns this and there's redepreciation corp, and he also owns another company called Depreciator. And in this fact pattern B, well, it's called other corporation, not redepreciated. Other corporation sells to redepreciation. And other corporation is 100% owned by our taxpayer. He's selling to a company in B in which he's owned 60%. This is 60%, this is 100%. And I'll just point this out to you because we don't need to belabor this. Look at 1239B1. B says, for purposes of applying subsection A, the term related person means a person in all entities which are controlled with respect to such person. And if you look at 1239C1, the corporation, he owns more than 50% of the value. One company owns 100%, one company owns 60%. Are these two companies related?
Yes.
Yes. So 1239 would apply, the outcome would give rise to ordinary income. Right? One alter ego is selling to the other alter ego. Question E, what resulted the sales between depreciator and a trust which depreciator's spouse is the income beneficiary? And if you look at 1239B2, a related party includes the taxpayer in any trust in which the spouse, in which the taxpayer, look at the parenthetical, or his spouse is a beneficiary. And in this case, 1239B2 would apply. Again, it's a sale to a related party. Question F. What results in E above? The taxpayer was a vacation residence of depreciator. Okay, so if you own a house, can you depreciate it? No. Everyone agree? If it's a vacation house and you don't rent it out, you can't depreciate it. And they live in it. In question E, they're going to sell it. So they take a vacation residence and they sell it to a trust who's now going to rent out the vacation residence. Is that 1239? Does 1239 apply? So originally the property is not depreciable, right? It's not a 1231 asset, agreed? And should Congress be worried? Because The sale will give rise to what kind of income in the absence of 1239? Capital gain, right? It's a capital asset, right? If it's an asset and it's not inventory, it's not used in the trade or business, not an account receivable, 1221 would say it's a capital asset, right? Your home is a capital asset. Your vacation home is a capital asset. You sell it to a trust, which is now going to rent it out. Is it depreciable? Is it a 1231 asset? Absolutely, right? Should Congress be nervous here? Congress should be very nervous here, right? Because this is the kind of situation 1239 was designed to stop, where a taxpayer could sell, grand capital gain rate, and then the related party get ordinary deductions. So all it says, 1239A, recall, it has to be depreciable in the hands of the transferee. Depreciable in the hands of the transferee, not the transferor. It wasn't depreciable in the hands of the transferor, agreed? It only has to be depreciable in the hands of the transferee.
So question F, still 1239?
Question F is the same outcome, 1239 applies.